Imagine your phone rings tomorrow morning, right? You pick it up, and it's a precious metals broker. They sound super professional, maybe even, I don't know, a little conspiratorial. Like they're letting you in on this exclusive wealth building secret.
Oh, yeah, the classic insider tone.
Exactly. And they drop this pitch on you. They say, hey, how would you like to add $6,000 in free gold to your portfolio using the gold you already own without spending a single dime today?
Right. Which, I mean, sounds amazing.
It sounds like the ultimate insider hack. Like, who wouldn't want to instantly increase their holdings without, draining their checking account?
Well, it is an incredibly seductive pitch, and it's entirely designed to weaponize human psychology. I mean, it plays on this nagging feeling a lot of investors have when they hold a physical asset.
The feeling that it's just sitting there.
Yeah, exactly. This idea that their money is just being lazy in a vault and they need to, put it to work.
Right, right. And that brings us to the actual mission for today's deep dive. We're looking at a pretty eye-opening educational guide published by First Gold Group, and it explores the realities of precious metals investing. But specifically, we are going to unpack how that exact phone pitch we just talked about has quietly wiped out massive portions of investors' life savings.
Yeah, it's a very real problem.
It really is. We're going to explore how a financial mechanism known as leverage can completely mutate gold, which is, one of the oldest, most fundamentally stable assets in human history, into this fragile ticking clock where the house almost always wins.
And, to really understand that mutation, we have to look at the concept of time. If there's one overarching theme I want you to keep in mind as we navigate this deep dive, it's that leverage compresses time.
Okay, compresses time. How so?
Well, gold is historically a 5,000-year-old asset, right? It's patient. It outlasts currencies, empires, all of it. It's meant to be held through long, highly volatile market cycles. But the second you introduce leverage, you strip away that patience. You essentially put a stopwatch on a glacier.
Oh, I love that
Uh,
framing. Put a stopwatch on a glacier because, well, to understand how we get to that point, we have to look under the hood at the underlying mechanics. Like, what is that broker on the phone actually offering you? If we look past the shiny promise of free gold, what am I actually doing? I assume I'm like taking out a loan.
You are, yeah. In the industry, this is typically structured as a physical gold loan with usually around a 60% loan-to-value ratio, or LTV.
Okay, 60% LTV. Walk me through the math on that. Let's say I have 10 grand in gold.
Okay, so you have $10,000 in fully paid off gold. It's sitting safely in a vault. You pledge that entire amount as collateral. The lender then extends you $6,000 in credit, which is your 60%. And then you use that borrowed money to buy more gold, bringing your total position up to $16,000.
Okay, so just to visualize this for a second,
Yeah.
it's like I'm sitting at a high stakes poker table, right? I'm playing my hand, but I feel like I need a bigger stack of chips to, I don't know, intimidate the other players.
Right.
So
Well,
instead of reaching into my wallet for cash, I take the deed to my completely paid off house, slide it onto the felt, and the dealer hands me a few more chips.
that's actually a very accurate way to picture it.
I've just taken an asset I owned free and clear with literally zero risk of losing it and voluntarily exposed it to the, immediate volatile swings of a poker game.
Precisely. Your existing gold is no longer just a passive safe haven. It's now legally tethered to a debt obligation. You're controlling a larger asset base on paper, but your actual equity remains exactly the same. The rest of it is just borrowed money.
But wait, hold on. Stop right there. Let's think about the incentives here for the broker making that phone call. Because if the dealer is loaning me the money to buy the gold from them, aren't they basically double dipping on this whole transaction?
Oh, they absolutely are. And that, frankly, is why this structure is pushed so aggressively on the phone. The broker isn't betting on the price of gold going up.
Right. They don't care about the market.
Exactly. They are betting on the transaction itself. They are creating a risk-free profit center for themselves by acting as both the seller of the asset and the financier of the debt. And that brings us to the structural costs.
Hidden anchors.
Yes, the anchors dragging down your portfolio from the literal moment you sign the paperwork.
Okay, let's unpack what those anchors actually are. Because if I am buying physical gold from a dealer, I know they don't sell it to me at the exact global spot price. They charge a retail markup, right? A spread.
Yes, exactly.
So if I'm borrowing $6,000 to buy more gold from them, I assume that spread applies to the new metal too.
It does. And the spread is simply the difference between what the dealer charges you to buy the metal and the bid price, which is what they would pay you if you turned around and sold it right back to them.
Right, the buy-sell gap.
Right. And in physical commodities, this spread accounts for minting, storage, dealer margins, all of that. It is totally normal in a long-term transaction. Like if you hold it for 20 years, the spread doesn't matter much.
Because the market growth covers it over time.
Exactly. But in a leveraged short-term trade, it is devastating.
So if the spread is, let's say, 10%, the second I buy that new $6,000 in gold, it isn't actually worth $6,000 if I needed to liquidate it.
Yep.
It's immediately worth 10% less, so I am starting in a hole before the market even opens the next morning.
You are underwater instantly on that finance portion. But the dealer has already locked in their margin. That's their first dip. The second dip is the financing cost.
Right, because it's a loan.
Right. You are borrowing that money, and currently the interest rate on these structures sits around 7% annually.
Wait, hold on. I'm stuck on the 7% interest rate. Let's think about the historical context of gold here. It's a bedrock asset, sure, but it's not exactly like a high-growth tech stock.
No, not at all.
I mean, it can trade sideways for years. If historical gold returns average somewhere in the, single digits annually, and my loan is costing me 7% a year, aren't I structurally doomed from day one? Like, I have to beat my own interest rate just to break even?
You've hit the nail on the head. You're creating a massive structural headwind for yourself. These costs exist whether the market goes up, down, or completely sideways.
Jeez.
You're paying a premium just to acquire the metal, and you are paying a 7% interest rate for the privilege of letting the lender hold it as collateral.
Which means I am essentially paying the lender to hold my own assets hostage. That is absurd.
It really is.
But okay. Let's play devil's advocate for a second.
Yeah.
Because people obviously take this deal. And they take it because they think they can outsmart the math, right? They think the market is about to just skyrocket.
Always. Everyone thinks they're timing the market.
Right. So let's run a hypothetical scenario here. Let's say I take the deal, I endure that spread, I pay the 7% interest, and I actually guess right. Let's say the gold market jumps 10% over the next 6 months. I should be thrilled, shouldn't I? Because the leverage amplified my gains.
Well, you would certainly think so. I mean, a 10% jump on a larger $16,000 position sounds fantastic on paper.
Yeah, because my original 10 grand is up.
Right. Your original 10,000 is up. Your
Yeah.
newly financed 6,000 is up. On paper, your total portfolio has grown substantially.
On paper, being the operative phrase there, because I'm guessing the second I decide to cash out and take my brilliant profits,
Yeah.
the toll collectors arrive.
Exactly. To
Yeah.
take your profits, you have to close out the loan. You have to sell the financed portion of the gold back to the dealer. And remember that first anchor we talked about, the spread.
Oh, right, the 10% spread.
Yep. You don't get to sell it at the new higher retail value. You have to sell it at the dealer's bid price.
Oh, wow. Okay, so even though the market went up 10%, that 10% spread I had to eat on the way in effectively neutralizes my gain on the way out.
It actually does more than neutralize it. Because you're selling at the bid price, the actual cash you get from liquidating that financed portion often isn't even enough to cover the original principal of the loan.
Wait, what?
Yeah, you actually end up with a minor shortfall. Let's do the math.
Yeah, let's break that down because that sounds crazy.
Okay, so your $6,000 in finance gold grew by 10%, right?
Right, so it's worth $6,600 retail.
Exactly. But you have to liquidate it at the bid price minus that 10% spread. So you're actually only getting back about $5,940.
Wow. Okay, so I owe them $6,000 for the original loan, but I only got $5,940 back from selling the gold.
Right, which leaves a $60 shortfall.
That is maddening. I borrowed money, the asset I bought with it went UP in value by 10%, and when I sell it, I still owe the lender money out of my own pocket just to clear the principal.
Just the principal.
Yeah.
And we haven't even factored in the interest yet.
Oh my gosh.
Right.
The 7%.
You still owe that 7% annual interest for the 6 months you held the position, which is roughly another $210.
Yeah.
Plus, as the first Gold Group guide points out, if you want your original metals shipped back to you, there are shipping and insurance fees to pay, which can easily be another $100 or $200.
Okay, so if we step back and look at the big picture of this supposedly winning scenario, I took on all this risk, I pledged my completely paid off assets, I correctly predicted a major 10% market jump.
Right.
And after the dealer takes the spread and the lender takes the interest and the shipping company takes their cut, what do I actually walk away with?
You walk away with a fraction of what you would have made if you had just left your original 10 grand alone.
Wow.
I mean, if you had just held your assets outright without leverage, a 10% bump gives you a clean, stress-free profit of $1,000. But with leverage, the structural friction slashes that return dramatically. You might net maybe $500.
That is wild.
You took 100% of the risk, but the structure ensures the house gets paid first, second, and third. You get the scraps.
So you won the battle, but the structure of the trade made you lose the war. It's just this incredible illusion. The leverage essentially requires this massive, unnatural, rapid upward spike in price just to clear the break-even point on the fees.
And that brings us right back to time compression. In a cash purchase, if gold goes down 5% this year and up 15% next year, you don't care.
You just wait it out.
Exactly. You wait it out.
Ugh.
But in a leverage trade, because of the interest and the spread, time is actively decaying your position.
Okay, so if winning yields such a diminished, frustrating return, we really have to look at the dark side of this. What happens when the market actually turns against you? Because, gold goes through corrections all the time.
All time, yeah.
Well, let's say I take the leverage and the market drops by a totally normal 10%. What happens then?
This is where we see the downside multiplier take effect.
Hmm.
And it is brutal.
Right.
Remember, leverage amplifies the movement of the entire portfolio, but your equity is only a portion of that portfolio.
Okay, let's think about this mathematically, but let's keep it simple.
Hmm?
If I control a larger pool of gold, right, but I owe a fixed debt of $6,000, that debt never shrinks just because the market went down.
No, it is not.
I owe what I owe. So every single dollar of loss across that entire $16,000 portfolio comes directly out of my initial $10,000 equity.
Exactly. You act as the sole shock absorber for the entire transaction. If the market drops 10%, the total value of the gold drops. Your 10 grand goes down to 9. The finance 6 grand drops to 5,400.
Okay, I'm tracking.
But when you go to exit the trade, you still have to sell the financed portion at the bid price, taking that 10% spread hit again.
Yeah.
And you still have to pay back the fixed loan amount.
Oh, no. So wait, if my finance part dropped to 5,400 and then I take a 10% spread hit on that, I'm liquidating it for what, like $4,800?
About 4860, yeah.
But I owe them 6 grand. So the liquidation value of the borrowed gold isn't anywhere close to covering the debt. The lender is looking at a massive shortfall, over $1,000. And where do they go to make themselves whole?
They go straight into your original collateral. They dip into the $10,000 you owned free and clear, and they take whatever they need to cover the loan deficit, plus the accrued interest, plus any fees.
Unbelievable.
So after all that, out of your original 10 grand, you might be left with maybe $7,400 or $7,500.
Wow. I'm trying to find the right way to visualize this. It's almost like riding a seesaw, but the pivot point is completely off-center.
Oh, that's a good way to put it.
Right. When you try to go up, it's this agonizing struggle against gravity, against the spreads and the daily interest. But when you go down, because the weight is entirely shifted against you, you just slam into the concrete twice as fast. A standard 10% market correction just wiped out a quarter of your entire life savings in this structure.
Yep. And it perfectly illustrates the central dynamic of this whole pitch.
Yeah.
The structure is meticulously engineered so that the lender assumes zero market risk.
Zero.
Right. Their loan is over-collateralized by your assets. You take all the downside, and as we saw in the winning scenario, you severely cap your upside.
That is such a terrible asymmetry. But honestly, as bad as losing a quarter of your wealth on a minor market dip is,
Yep.
that assumes I chose to sell, right? That assumes I looked at the market and said, you know what, I'm out.
Right.
But from reading this first gold group guide, it seems like the most dangerous part of this entire scheme is that you don't actually get to choose when you sell. The lender can force your hand.
Yes. This is the crux of the entire deep dive right here, the margin call. When you take out a physical gold loan, lenders apply a maintenance threshold. It is typically set at an 80% loan-to-value ratio.
Okay, why 80% specifically? Like, what is the significance of that number to the lender?
It's their safety cushion.
Yeah.
If the amount you owe ever equals 80% of the total current value of your gold, the lender's buffer is getting too thin for their comfort. They want to ensure that if the market keeps dropping, they can aggressively liquidate your gold, cover their debt, and not lose a single penny themselves.
Okay, so if my debt hits 80% of my total portfolio value, alarms go off. But here is the thing that makes zero sense to me. The market doesn't even have to drop for you to hit that margin call, does it? The trigger is moving independently of the gold price.
And that is the most insidious mechanism in the entire structure. The margin call threshold creeps closer to you every single day, even if the price of gold is completely 100% flat.
Because of the 7% interest.
Exactly. The interest accrues daily. Every single day, the total amount of money you owe the lender gets a little bit bigger.
Yeah.
And because your debt is growing, it represents a larger and larger percentage of your total portfolio value.
Yeah.
Your loan-to-value ratio is constantly rising, just silently in the background.
Oh, man. It's like buying a car on a loan where the dealership gets to define the blue book value of the vehicle every single morning.
Yeah.
And if that arbitrary value ever drops below what you owe them, they don't even call you. They just repossess the car while you're driving it to work.
That is a terrifyingly accurate analogy.
Mm.
Let's look at how quickly this trap can spring, because this is what catches people off guard. Let's look at the 4-month trap.
Okay, what's that?
Imagine the market is perfectly flat for 3 months. Gold does absolutely nothing. But your loan balance is growing because of that daily interest, right? So the noose is tightening just a fraction of an inch every day. Then in month 4, a totally normal market event happens. The Federal Reserve makes an announcement, or employment data comes out, and gold dips by just 8%.
Which is nothing. It's a blip. It's the kind of volatility you wouldn't even blink at if you own the asset outright.
Exactly. But in a leveraged position, that 8% drop, combined with your swollen loan balance, is catastrophic. Your equity cushion vanishes, your loan-to-value ratio breaches that 80% maintenance threshold. You hit, say, 83%.
And the lender doesn't care that gold will probably bounce back next week, right?
They don't care at all. Their algorithm just flagged your account, you get an email or a phone call, and suddenly you have a 72-hour deadline. You are demanded to wire a massive cash deposit, sometimes thousands of dollars, immediately, just to bring your account back into good standing.
And if you are like most normal people and don't have thousands of dollars sitting idle in a checking account ready to wire at a moment's notice, what happens?
Then the lender forcefully liquidates your gold. They sell a portion of the assets you pledged to them at the prevailing bid price, right at the bottom of the market dip, to pay down their loan.
Wow. So they force you to sell at the exact worst possible moment.
Yes, a margin call locks in a temporary paper loss permanently. An 8% market blip something the asset is literally designed to absorb over a 30-year horizon triggers the forced, panicked sale of the very wealth you were trying to protect.
This brings us right back to your earlier point about time compression. I mean, if I buy gold with cash, put it in a vault, and the price drops 8%, nothing happens.
Nothing at all.
My life doesn't change. I go to sleep, I wake up, the gold is still there, I have the luxury of patience, I can wait 5 years for the cycle to turn. But the leverage introduces this brutal artificial countdown clock. It forces sudden, desperate financial decisions over incredibly short, high-stress timeframes.
Which is precisely why the source material emphasizes that First Gold Group refuses to engage in leveraged transactions. I mean, their entire philosophy is built around full ownership. They argue that introducing these complex debt structures fundamentally breaks the utility of the asset.
Yeah, that makes total sense.
Right. You are basically paying a premium to limit your own ability to survive a normal market cycle.
It just shifts the entire power dynamic. When you own the physical metal outright, you are the sovereign owner of your wealth. You dictate the timeline. But the moment you sign that loan agreement, the lender dictates the timeline. And in the financial world, whoever controls the timeline ultimately controls the outcome.
That is a fundamental law of markets.
Hmm.
If you are forced to sell on someone else's schedule, you are almost guaranteed to lose.
It's just wild to think about the psychological disconnect here. And that actually leads me to a final thought I want to leave you with today as you consider how to navigate these kinds of pitches in your own life. Think about the fundamental philosophical reason people gravitate toward physical gold in the first place. Usually it's a desire for independence. It's a desire for stability, to step outside the fragile, interconnected web of modern banking, counterparty risks, Wall Street debt cycles, all of that. You want something real, something that is yours.
Right.
So here's the question you really have to ask yourself. If the entire appeal of buying physical gold is to achieve freedom from the banking system, doesn't using that exact same gold as collateral to take out a high-interest loan from a financial institution completely defeat the entire purpose of owning it? You are taking an instrument of financial independence and voluntarily chaining it right back to the exact system you're trying to hedge against.
Yeah, you are buying a life raft and then instantly renting it out to the captain of the sinking ship.
Exactly. I love that. It completely contradicts the core thesis of the investment. It's definitely food for thought the next time a smooth-talking broker offers you a shortcut to wealth. Because as we've seen today in the world of leveraged precious metals, free is usually the most expensive word in the dictionary.
It always is.
Thank you so much for joining us on this deep dive into the hidden traps of alternative investing. We hope breaking down these mechanics helps you protect your hard-earned wealth. Stay sharp, trust your instincts, and keep digging.